Welcome and thank you for joining us for Retirement Decisions Observed Second Look. Let's review between ages 60 and 70. The years between 60 and 70 can be some of the most important planning years of retirement, not because every decision is dramatic, but because many decisions start to overlap. So healthcare overlaps with retirement planning, Social Security overlaps with taxes, IRA withdrawals overlap with Medicare premiums, and then estate planning overlaps with beneficiary forms. So one way to think about today's session is this. Most retirement surprises do not come from one obviously bad decision. They often come from several reasonable decisions made separately without seeing how they affect each other. Today is not a market forecast, not a product presentation or individualized planning recommendations. It is an educational framework to help you ask better questions and identify decisions that may deserve a second look. My name is Brennan. I'm a paraplanner here with Vantage Financial. My work happens mostly behind the scenes. I build and stress test the retirement plans our clients rely on, which means I spend my days in the details, Medicare timing, withdrawal sequencing, tax windows, and the places where those decisions run into each other. Joining me today is my colleague, Sophia. Tronolone. Sophia is a financial advisor here at Vantage Financial, and she works directly with households in exactly the stage of life we're talking about today. The years between 60 and 70, when retirement planning stops being theoretical, starts having deadlines attached to it. Sophie sits across the table from these decisions every week. So as we move through the material, she's going to bring real world side of the conversation, questions people actually ask, where they tend to hesitate, and what most often gets overlooked until it is urgent. Sophie, thanks for being here. One quick note on format before we start. We will move through 7 short chapters today, 7 individual topics, and we'll leave time for questions at the end. We will be monitoring the Q&A chat, so feel free to drop your questions in there during the presentation. We will wait till the end to address those. But other than that, Sophie, it's all yours.
Awesome. Thanks, Brennan. Appreciate the introduction. Good afternoon, everybody. I'm excited to be here today to talk more about why ages 60 to 70 are a planning crossroads. So between the ages of 60 and 70, retirement planning often shifts from theory to timing. So before this decade, many conversations are about saving enough money, right? We're in the accumulation phase. You're preparing for retirement, socking away as much money as you can. But during this decade, the questions become more specific. They turn into, when do I retire? How do I replace my paycheck? When should I claim Social Security? How do I cover my healthcare needs? Which accounts do I spend from first? To make this practical, we're going to use a couple fictional examples today. So Pat and Dana, they are 63 and 61. Pat wants to retire soon, but Dana still needs healthcare coverage before Medicare. Jamie is 64, single, and wants to understand how retirement income would actually work month to month. Alex and Morgan are 66 and 64, and they're trying to coordinate Social Security and survivor income. And Marcia is 62 and has a large traditional IRA that could create future tax issues. So these are all different but fictional households, different facts, different goals, and different concerns. But there's the same common theme, which is that these decisions deserve to be coordinated. Now, before we go further, a quick but important note. This session is designed to be educational. So we'll be talking about planning concepts, again, common timing issues, and hypothetical examples. We will not be making individualized recommendations today, again, because every household situation is dependent on their income, their assets, health, taxes, family structure, insurance, and personal goals. So the goal for today's session is not for you to leave with every single answer. The goal is for you to leave with better questions to ask your professionals in your life. So a good question might be, should I review my Medicare timing before I finalize my retirement date? Or could a Roth conversion affect my Medicare premiums? Or do my beneficiary forms still match my estate plan? That's the kind of second look we want to encourage. Again, these are questions you can be thinking about to ask your financial planner or advisor, your tax professional, your estate planning attorney. Again, every household is different, so we want you to feel equipped and know that you're asking the right questions. So let's start with the timeline between ages 60 to 70. So at age 60, a lot of people are still working, but retirement decisions are getting closer, and those thoughts are starting to creep in about what that's going to look like. At 62, individuals are first eligible to receive Social Security benefits at a reduced rate. At age 65, Medicare becomes the major planning issue. Medicare's initial enrollment period lasts about 7 months. So it starts 3 months before you turn 60, 3 months before you turn 65, the month you turn 65, and 3 months after. Then, for most individuals, full retirement age is 67. That's if you're born in 1960 or later. So, 67 is when you are eligible to receive 100% of your Social Security benefit. And at age 70, that is the maximum benefit you can receive for Social Security. So the question really isn't simply when do I retire? A better question to be thinking about is which of these decisions have timing rules and which ones become harder to fix if I wait too long.
All right, so here's a very common situation. So Pat is 63 and says, I think I want to retire in about 90 days. That sounds like a retirement date decision, but almost immediately it becomes 5 decisions. How will Pat and Dana cover healthcare? Where will monthly income come from? Should tax withholding change? How much cash should they keep available? Should Pat claim Social Security now, later, or not yet? None of those questions are impossible, but they're much easier to review before retirement is 90 days away. That is the theme of today. The earlier you identify these decisions, the more flexibility you usually have. All right, so let's look at Pat and Dana. Pat is 63, Dana is 61. Both are currently covered under Pat's employer health plan. All right, Pat would like to retire this year. Here's a second look question. If Pat retires now, how do they bridge healthcare coverage until Medicare? Pat may need about 2 years of coverage before age 65. Dana may need about 4 years. So the retirement date is not just an income decision, it is a healthcare decision. Their options might include retiree medical coverage, spouse coverage if available, COBRA, marketplace coverage, or private coverage. Each option can have different premiums, provider networks, deductibles, and tax interactions. So the plain takeaway is simple. Before retiring, before Medicare age, healthcare should be reviewed as part of the retirement income plan, not after the retirement date is already set. Medicare timing is one of those areas where people often assume the rules are simpler than they are. Generally, Medicare's initial enrollment period, like Sophia said, begins 3 months before the month you turn 65 and ends 3 months after the month you turn 65. But the real world question is often more complicated. All right, what if I'm still working at 65? What if I'm covered by my spouse's employer plan? What if I have an HSA or a health savings account? What if my employer has fewer than 20 employees? Those details matter. So, for example, Medicare notes that people with health savings accounts should coordinate contributions carefully when working past 65. In some cases, people and employers should stop HSA contributions 6 months before retirement or applying for Social Security or retirement benefits to help avoid tax penalties. Second look question here is, before I turn 65, have I confirmed which Medicare decisions apply to me based on my actual coverage situation? All right, let's compare 2 retirees. Okay, Susan travels 4 months per year, spends time in multiple states, and values provider flexibility. Mark rarely travels, has doctors close to home, is most focused on keeping monthly premiums predictable. Okay, they may both be 65, they may both be healthy, but they may not value the same Medicare structure. This is why Medicare is not just a checkbox. People often need to compare original Medicare, Medicare supplement coverage, Part D prescription drug coverage, and Medicare Advantage. Each path can involve trade-offs around premiums, networks, referrals, prescription coverage, out-of-pocket exposure, and travel flexibility. Planning takeaway is that Medicare should be reviewed based on healthcare usage, preferred doctors, prescriptions, travel, budget, and risk tolerance. All right, now let's bring in Marcia. Okay, Marcia is 62, recently retired, and has a large traditional IRA. Okay, she's considering a $75,000 Roth conversion because she has heard that lower income years before required distributions can be useful. That may be worth reviewing, but here's a second look question. Could a good tax move in 1 year create a Medicare premium surprise later? Medicare premiums can be affected by income. Medicare explains that Social Security determines whether income-related monthly adjustment amounts, often called IRMAA, apply to Medicare Part B and or Part D. So that does not mean Roth conversions are bad. It means Roth conversions, capital gains, IRA withdrawals, Medicare timing, and future premiums should not be reviewed in isolation.
All right, so let's take a look at Social Security now and how it's more than just an age choice. So let's consider Jamie's situation. She is 64, single, and would like to retire next year. Jamie's projected Social Security benefit is $2,000 per month at full retirement age. And Jamie's asking the question, should I claim now? Should I claim early? That's a very reasonable question. But a better question might be, what problem am I trying to solve by claiming early? So is Jamie wanting to claim early because her portfolio can't support spending, because work has become stressful, because health is a concern, because Jamie wants to preserve investment assets, or simply because, hey, age 62 is when I could start claiming. I've delayed a couple years, and if I'm going to retire, I'd like to start replacing that paycheck. All of those are fair considerations. So, as we've mentioned, Social Security benefits begin at age 62, but claiming before that full retirement age means you're accepting a reduced monthly benefit. So again, for people born 1960 or later, that full retirement age is going to be age 67. The planning takeaway here is that Social Security really needs to be coordinated with your cash flow, your tax picture, health and longevity expectations, as well as other income sources. Now let's take a look at Alex and Morgan's situation. So Alex is 66 and he has a projected Social Security benefit of $3,200 per month. Now Morgan is 64 and has a projected benefit of $1,400 per month. So it's pretty tempting to ask, how do we maximize that income today? But for married couples, another question may matter more. What happens to household income when one of us passes away? So for a single retiree, Social Security claiming is often focused on personal cash flow and longevity. But for a married couple, survivor income may also matter. For a widow or widower, the claiming sequence may involve retirement benefits and survivor benefits. And for divorced individuals, prior marriage history may be relevant. So the question here is, are we only looking at kind of that first retirement phase, or are we also looking at the surviving spouse's income later and if they will be taken care of? So, replacing the paycheck, one of the biggest emotional shifts in retirement that we see all the time is going from a paycheck to a withdrawal plan, right? People are used to working for a majority of their life, saving and investing money, and it becomes a really hard emotional, switch to start spending those dollars without additional income coming in. So looking at Alex and Morgan's situation, they need about $8,000 per month after tax to maintain their lifestyle. So between Social Security and a small pension, they're going to expect about $5,500 per month, which is leaving a $2,500 a month, what we call income gap. So that gap doesn't automatically mean you have a problem, but it means you need a plan. So is that going to come from cash reserves, taxable investment accounts, traditional IRAs, a Roth IRA, part-time income, or maybe like a pension distribution option or something else? So the question here would be, if this paycheck stops, where does my monthly income come from, and how does that impact my tax picture? Again, another common question is which account then should I be spending from first? So if we're thinking about the different types of accounts we can look at, let's say there's, cash and checking, taxable brokerage account, a traditional IRA, and a Roth IRA. The obvious question is again, where can we spend from first? But the better question to think about is which withdrawal strategy creates the most flexibility after tax? So a dollar from a checking account, dollar from a taxable account, dollar from a traditional IRA, and a dollar from a Roth IRA do not have the same tax result. So the order of withdrawals can affect your current taxes. They can also affect your future required minimum distributions. They can affect your Medicare premiums, investment flexibility, and your estate planning, right? So the planning takeaway is that retirement income planning should focus on kind of an after-tax cash flow, not just different account balances. This is something that is necessary to evaluate on an annual basis. Where you take your income from one year may change the next year depending on how circumstances change. Your income picture, if you've done Roth conversions, where tax rates are, Medicare, etc.
All right, so let's jump over to tax planning windows, retirement, and RMDs with Marcia here. So Marcia retires at 62. She's not started Social Security yet. She has a large traditional IRA, a little bit of taxable savings, and a few years before required minimum distributions begin. This may create what planners often call as a tax window. The question is not, should Marcia automatically convert to Roth? Okay, the question is, are there lower income years where it may be useful to review Roth conversions, capital gains, charitable giving, or withdrawal strategies? Planning window is valuable only if you see it while it is open. If Marcia waits until required distributions begin, she may have less control over taxable income. IRS guidance says IRA owners generally must begin RMDs for the year they reach age 73, though the first RMD may be delayed until April 1st of the following year. So RMDs for people that are age 73 are people that are born before the year 1960. And then for individuals that were born in 1960 or after, your RMD age is 75, all right? So the second look question here is, are we using the years before RMDs intentionally? Okay, this is probably one of the biggest areas of opportunity for individuals listening to this call, and then also just people that are approaching retirement, in retirement, and then also looking at RMDs at 73 or 75. All right, so let's say Marcia considers a $40,000 Roth conversion. By itself, that number does not tell us whether it is good or bad. The right question is, what does that $40,000 conversion do to her tax bracket? Does it affect Medicare premiums later? Does she have cash outside the IRA to pay the tax? Does it support estate goals? Does it reduce future RMD pressure? And then would charitable giving be a better fit? Okay. The same type of review applies to capital gains and charitable strategies. Now, this is why tax planning between 60 and 70 should usually be coordinated with both the advisory team and the tax professional. Okay. Not every opportunity is worth taking, and not every year is equally as useful. All right, so Marcia has a $1.2 million traditional IRA. That is a wonderful retirement asset, but tax deferred does not mean tax free. Okay? It means the tax decision has been postponed. It's like a joint partnership with the IRS. If Marcia waits until required minimum distributions begin to think about the IRA, she may have less flexibility. Required distributions can affect taxable income, Medicare premiums, portfolio withdrawals, charitable planning, and the tax situation of a surviving spouse or heir. IRS guidance states that many IRA owners must begin RMDs for the year that they reach age 73, like we spoke about, 73 or 75. The second look question here is, should tax deferred accounts be reviewed before withdrawals are required? All right, now we're jumping over to Chris. Okay, we're switching from RMDs and tax planning now to insurance planning. Uh, Probably a lot of the households that we work with are probably noticing the theme here. It's following a lot of the elevator retirement plan. Those six key concepts we live by here. You'll get a breakdown at the end of the webinar today on that. But yeah, those six key areas that we are planning within for households to work with. Um, Also want to share too, we had a question that came in, not necessarily specific to the concept or to the content we're working through. It had more along the lines if we would be providing a link to the recording or the presentation today. I'll answer this one in the middle just because I'm sure some of y'all are also wondering this. We will be sending out a recording of today's webinar to the people that have participated. One thing, we will not be sharing the slide deck or presentation. We usually just provide a recording of the presentation. So that will be sent to you once we wrap up today. All right, so back to Chris. Okay, so Chris is 65 and owns a $750,000 life insurance policy purchased years ago. Okay, we see this all the time. We see people that have term life insurance that go into retirement that when they originally got it, they were protecting against the what ifs, income replacement, paying off your mortgage, providing some type of money for your children's education if you're no longer there. So this is a very common question or analysis that we do on our end. When he was working, the time or the purpose of this life insurance was very clear. Okay, like I said, it was protect the mortgage, provide for children, and replace his income. Now the mortgage is nearly paid off, the children are independent, and Chris is entering retirement. Okay, does that mean the policy is no longer needed? Maybe. Or maybe the purpose has changed. So may still support a surviving spouse, legacy goals, estate liquidity, business obligations, or family support, or it may no longer fit. The second look question is not, do I have insurance? It is, what risk is this insurance designed to address today? All right, now we're going to jump from a life insurance scenario to a long-term care scenario. This is one of my probably areas with the households that we work with that we make the biggest impact. And why that is I don't think enough people talk about this or understand what is down the road if they have not experienced something like this with family. So highly, highly recommend households that are listening today to have a care plan. And then also, make sure that if your partner are on the same page if something like this were to happen to one of you. So Sam and Teresa are retired and they're helping caring for an aged parent, and kind of what sparks this discussion between them. They begin asking a question many families eventually face is, what would happen if one of us needed care? This is not just an insurance conversation. It is a family conversation, a housing conversation, a cash flow conversation, and often a legal document conversation. Who would provide care? Would the goal be to stay at home? What assets would be available? And what role might insurance play? Okay, are adult children aware of the plan? And then are powers of attorney and healthcare directives current? Okay. Biggest question here is to ask yourself and your partner is, do we have a care plan? Or are we assuming the family will improvise during a crisis?
That's awesome. I love that question. At Vantage Point, our philosophy is basically, we don't believe that every single individual needs a long-term care insurance policy, but everyone needs a plan, right? We have to plan for those scenarios. That segues us nicely into kind of our estate planning chapter for today's session. So beneficiaries and estate planning gaps. Let's take a look at Evelyn's situation. So she is 68 and recently widowed. She updated her will after her husband passed. That's a good thing, right? But her IRA beneficiary form still lists some outdated beneficiaries. Here's a second look question. Which document actually controls the IRA? So once Evelyn passes, does the will dictate this or does the beneficiary form dictate this? And the answer surprises a lot of families. So beneficiary designations on retirement accounts, life insurance, and transfer on death accounts often override the will. So a will update alone may not be enough to actually, dictate what she wants to do with this IRA upon her passing. So this is especially important to note after a divorce or a remarriage, the death of a spouse, birth of grandchildren, blended family changes, family conflict. The planning takeaway really is that estate planning is not only about having your documents in place, it's about making sure these documents, your account titlings, and your beneficiary forms all point in the same direction. So, some lifestyle decisions behind the financial plan. Pat and Dana budget about $7,000 per month in retirement. Then they kind of start adding some details. They want to travel more in the first 5 years. They need a new roof. They want to help one of their children with a down payment. They want to visit their grandchildren a few times per year. Healthcare costs may be higher than expected. So suddenly, their real number is actually closer to $9,500 per month in the early years of retirement. This is why retirement planning should not be built only around average spending. Many retirees kind of use this phrase, maybe you've heard it before, called the go-go years, the slow-go years, and the no-go years. So the go-go years meaning higher spending, you're more active, you're excited to be in retirement, you're traveling more, you're doing all of these activities. Your slow go years maybe mean kind of midway through retirement, you slow down that travel, kind of more of a moderate pace, reduced outings, and the no-go years, meaning increased healthcare and care-related costs. So the second look question here is, does our retirement income plan reflect the life that we actually want to live? And so this is a really key piece to keep in mind. A lot of people think, oh, well, that rule of thumb floating out there is I'm only going to need to spend 80% of what my income is now. But that really depends on what kind of lifestyle you want to live. So that's not, always the most accurate rule of thumb to go based off of. It really should be dictated by what are your goals in retirement and what kind of retirement do you want to live. So, how these decisions interact. Let's kind of pull this together. So let's say Marcia takes a $60,000 IRA withdrawal. That seems kind of like a simple income decision, but it's really not. That can affect her tax bill. It can affect her Medicare premium calculation in a later year. So future IRMAA surcharge. Again, IRMAA is income related monthly adjustment amount. That can create higher premiums up to 2 years later. Reduced tax deferred capital, so there's less of an amount compounding inside that IRA. So it's going to affect, how much of her portfolio remains tax deferred. It can affect her Roth conversion strategy. So there's less room in a tax bracket for some planned conversions there. And it's also going to affect a potential inheritance, which assets are left to different heirs. So that's the core message of today's session today. Retirement decisions rarely stay in separate lanes. Healthcare, Social Security, taxes, income, insurance, estate planning, you name it, lifestyle goals, they all interact with one another. Where you make a decision in one piece affects the rest of the puzzle. So the second look question is, are we reviewing these decisions together or one at a time? As we wrap up here, here's kind of a second look checklist. So again, between ages 60 and 70, consider reviewing your retirement date, your healthcare bridge, Medicare timing, HSA, health savings account coordination, your Social Security claiming strategy, your income plan, your withdrawal order, tax planning windows. I can go on and on. Roth conversion opportunities, RMD exposure. There is a lot to digest here. What are your insurance needs going to be? Long-term care. And most importantly, again, what are your goals in retirement? What kind of retirement do you want to live? That's really going to dictate, your planning with your professionals. So this sounds like a lot, I'd imagine, because it is. right? The point is not to solve everything today. It's not to overwhelm you, but it's to kind of help you identify which decisions determine or deserve your attention the most before they become really urgent.
Like we said earlier, um, you can kind of see where each of these topics were coming from, especially the households that currently work with us. This comes from what we call the elevated retirement plan. Um, is built around those six connected disciplines, six key areas. Okay, it starts at the center with goals and concerns because the plan should follow the life, not the other way around. Your goals, your priorities should drive every other decision within this plan. And if you have a plan that doesn't, and you don't feel like that's currently happening, I highly, highly recommend you to take the questions that you've gotten from today, concerns that you've gotten from the webinar today, and take it back to your professional and make sure that you feel confident that your plan is taking into consideration what means most to you. From there, you have income planning. Okay, it's how you build a dependable retirement paycheck, also protected against market drops and avoid being forced to sell at the wrong time. Next section here is the investment management piece. It's how you align risk with time horizon. Okay, using tools like the bucket plan. So the money you need soon is not exposed to the same risk as the money you need in 20 years. Next is tax management. Okay, it's why the order of withdrawals matters and how to avoid the traps we talked about today, like a surprise RMD or an IRMAA surcharge 2 years down the road. Healthcare and insurance, Medicare timing, bridge coverage before 65, long-term care, and whether the policies you own still match the risk you actually have. And then in legacy planning, right, beneficiary forms are up to date, account titling, estate documents, and what passes the people you care about the most. As I go through all six key of those areas, I can imagine that a lot of you are seeing how each one is intertwined with one another. Okay, you can't make an income planning decision unless I understand how it's invested or how I'm invested and understand the tax consequence of that income plan. Okay. Notice it's not a wheel either. Okay, it is a list, or it's a wheel, not a list. Okay, and that's by design. We could not go deep on all six key areas in this time that we had today, but the framework shows you something worth taking with you. Okay, these six key areas are connected, and when you plan them together instead of one at a time, you make better decisions and you avoid the expensive surprises.
Absolutely.
That brings us to the end of the information that we had for y'all today. Thank you again for spending time with us. We will open up everything up to questions here in the next two slides. But if today you raised a question about your situation, here is how to reach us. Okay, our website is vantagepointfinancial.com. And learn more and request a conversation. You can also call us at our office at 331-204-6209 or email us at retirement@vbtfinancial.com. You can also find us on LinkedIn and Facebook, where we keep updates on upcoming events, places you can find us in the community. Both of those are great ways just to see what our team's doing other than financial planning. And then our Chicagoland office is at 2443 Warrenville Road, Suite 630 in Lisle, Illinois. There's no cost, no obligation to have a first conversation with us. If you'd like a second look at one of the decisions we covered today, your Medicare timing, your claiming strategy, your withdrawal order, your insurance, or your beneficiary forms, we're glad to walk through it with you. One final reminder, everything we discussed today was educational. None of it was individualized tax, legal, or investment advice. So please coordinate any decision with your own tax, legal, and advisory team before you act on it. One last thing before we take questions. We run these educational sessions regularly. And the next two build directly on what we covered today. Okay, on August 12th at 12 p.m., we're doing a full session on Roth conversions. That will be led by two advisors on our team, one being one of our co-founders, Nick Ryland, the other advisor, Luke Mraz. we only had about a few minutes for today, but we'll walk through how to evaluate a conversion year by year. Okay, how to think about the bracket room you have, where the payment should come from, and how IRMAA fits into the timing. Okay, and then on September 23rd at 12 p.m., we have a webinar, Charitable Giving Beyond Cash. I believe Naomi Preden, one of our client service members, and then also another advisor, Don Robinson, will be running that webinar. So tune in there. They'll cover qualified charitable distributions, gifting appreciated securities, donor advised funds, and how giving strategies interact with the tax window we talked about earlier today. Save the dates, details, and registration are at vantagepoint-financial.com under the events tab. And we'll send the links to everyone who registered for today. So thank you all again for joining us. Sophie and I are happy to take your questions now. So let's see here.
Yes. So quick note, this QR code on the screen, if you scan this QR code, it takes you to our website directly. You'll have to direct to events, and then Chicagoland events. And this is where you can find, the sign up for these sessions as well. So feel free to, share these with any other individuals or families that could benefit from these types of conversations. Maybe that they want to learn more about Roth conversions. Feel free to send them this link. We'd be happy to, help educate as many people as we can.
All right, I got two questions here. One is when you approach age 65, you have 3 leading months before 65 and 3 months after sign up for Medicare. What exactly do you need to sign up for in Medicare if you're still working and have a job with benefits, i.e. Medicare A, B, and D? So this one's kind of nuanced in the sense of it does depend on how many employees the employer has. So in the case, if you have an employer with 20 or more employees, and you're still working there, your group plan will still stay primary. And you can wait to sign up for Medicare once you do start to need it for retirement. So if you're working, you do not need to sign up for it. I think if you have fewer than 20 employees, you will need to sign up for Medicare. I believe A and B. We can send a follow-up answer to this question, Sophia. You might be able to add to this, but that's my interpretation of the rules.
I missed that last part. I was monitoring the chat there.
No, you're good. Yeah, I'll send a follow-up email to all the participants, but I do think there's a little more nuance if you have fewer than 20 employees in your working. So
Yeah, that's definitely one of the considerations.
and then the other question that I saw is when you reach your Social Security full retirement age, if you keep working on a job, can you claim your Social Security penalty free with your work wages, or is that a limit you can that can be made before Social Security is taxed? So this one's another one that has a couple different rules to it. The year before you reach full retirement age, if you're working and claiming Social Security, is $1 withheld for every $2 earned above roughly $24,000 a year. Of course, they have different rules in the year you turn full retirement age. Can't be straightforward. So $1 withheld for every $3 above like roughly $65,000, I believe. And you only count the earnings in the months before the full retirement age month. Okay.
Yep.
Once you turn full retirement age, you can earn as much money as you want, and there's zero reduction to the benefit. Okay. So those are the two questions that we got during that.
Another question I'm seeing in the Q&A is, will the Roth conversion seminar provide a procedure using things such as previous tax return information to determine how much to convert and stay below the first IRMAA threshold? So I can't guarantee that we will give the exact answer to that of, a formula to use to determine that exact amount, but we will definitely talk through different scenarios, things to consider. If you're trying to stay below the first IRMAA threshold, what are some factors that maybe you weren't thinking about before that could impact, what tax bracket you stay in. So that will definitely be part of the conversation. It just might not be an exact procedure. That's a great question, though.
Awesome. We'll hang out for probably another 5 minutes if anybody has questions that come up. But if you don't have any other questions or concerns, thank you for participating today. We have really enjoyed our time with y'all. And if anything comes up after the webinar and the recording that y'all get via email, please feel free to reach out to us on our team. I'm more than happy to answer any other specific questions to your situations.
Yeah, we appreciate it. Thanks everybody for joining.